The Minority Market. Episode 27. Why Price Moves Before News. Most beginners believe news causes price movement. They wait for announcements, results, government decisions, or breaking headlines and expect the market to react afterward. This belief keeps them one step behind reality. In the market, price often moves before news becomes public. This is not magic. It is the result of information flow, expectations, positioning, and human behavior. Large institutions, professional investors, and insiders constantly analyze data long before headlines appear. They track supply chains, corporate activity, economic signals, and market sentiment. When they sense changes coming, they start adjusting positions quietly. These early actions create price movement even before the general public knows what is happening. By the time news becomes public, much of the move has already occurred. Another important factor is expectations. Markets do not react to news itself. They react to whether news is better or worse than what people expected. If good news is already expected, price may not rise. It may even fall because there are no new buyers left. If bad news is expected, price may rise when reality is not as bad as feared. The minority understands that price reflects expectations, not just facts. Think of the market as a crowd watching a movie trailer. If everyone already knows the ending, the final scene will not create surprise. Similarly, when information is widely anticipated, price adjusts in advance. Beginners who trade based on headlines often enter late and face losses. The minority focuses on behavior and price action rather than reacting to news emotionally. Another reason price moves early is positioning. Traders and institutions position themselves ahead of events. Before earnings, budget announcements, or policy decisions, large players adjust exposure. These positioning changes create supply and demand imbalances, which move price. When the event finally happens, many positions are already built, reducing the impact of the news itself. Insider activity also plays a role. While illegal insider trading is restricted, information often leaks indirectly through supply chain signals, corporate behavior, hiring patterns, or unusual activity. Smart money notices these signals early. The minority does not try to chase insiders. Instead, they learn to observe unusual price and volume behavior that may indicate early positioning. News media amplifies emotional reaction. Headlines are designed to attract attention. They often exaggerate fear or excitement. When beginners trade based on news, they are usually reacting to emotional storytelling rather than actual market logic. The minority treats news as background information, not trading signals. Another trap is believing that every price movement needs a news explanation. Markets can move simply because of technical levels, profit-taking, or shifting sentiment. Journalists often assign stories to explain movements after they happen. This creates the illusion that news caused the move, even when it did not. The minority understands that cause and effect in markets is rarely simple. Understanding this concept changes your behavior. You stop chasing breaking news. You stop entering trades late. You start observing price behavior, volume patterns, and market structure instead of emotional headlines. This shift reduces stress and improves timing. Here is a simple exercise. Next time major news is released, observe what price did before the announcement. Look at the chart. Did price already move? Did it consolidate? Did volume increase? This practice trains your awareness and helps you understand how markets anticipate events. Another powerful benefit is emotional control. When you stop believing that news controls everything, you stop panicking during headlines. You become calmer and more rational. You begin thinking in probabilities instead of reactions. The minority also understands that news is temporary. Markets move on quickly. Long-term success does not come from reacting to daily headlines. It comes from understanding behavior, structure, and long-term trends. Remember, the market is a forward-looking system. It constantly tries to predict the future, not reflect the present. Price moves because of what people believe will happen, not what already happened. If you can internalize this idea, you gain a major psychological advantage. As you continue your journey with the minority market, keep training yourself to observe first and react last. When you learn to respect price behavior more than news noise, you stop being manipulated by emotions and start building a disciplined market mindset. This is how the minority stays ahead, not by having secret information, but by understanding how markets truly move.